Welcome to this explainer. Look, scalping is one of those things, it's a dream for a lot of traders, right? It can be incredibly profitable, but let's be real, it is brutally difficult if you don't have a structured playbook. You're just flying blind. Today, we're going to change that and dive right into the exact strategies you need to build a rock-solid playbook of your own.
So, here's a massive question to kick things off. Why do 90% of beginner scalpers lose money? 90%. It's a staggering statistic, but the data shows beginners don't fail because they aren't smart enough. They fail because they're trading entirely on emotion and guesswork, rather than sticking to strict, predefined rules.
And without those rules, you naturally fall into three incredibly common traps. You end up entering trades way too early because of major FOMO, you exit way too late because of greed, or you just get completely chopped to pieces in false, manipulated moves. That is exactly why we're moving away from the guesswork today and breaking down three high-probability strategies that actually work.
Here is our exact roadmap for this explainer. First, we'll cover market structure. Then, we'll dive into Strategy 1 on moving averages, Strategy 2 with momentum wicks, and Strategy 3, the pattern scalp. And finally, we'll wrap it all up with what I like to call the money zone. Let's get into it.
All right, starting with number 1, understanding market structure.
Listen, before you even think about placing a single trade, you absolutely have to know what condition the market is in. It's foundational. If we're in an uptrend, you'll see higher highs and higher lows. That means buyers are aggressively in control. If it's a downtrend, you're getting lower highs and lower lows, meaning sellers are totally driving the bus. Our whole objective here is just to capture that next impulsive move right along with the trend.
But what happens when it's neither? Well, that's a range-bound market. Buyers and sellers are perfectly balanced, and the price just bounces sideways between support and resistance. Now here is a fascinating and crucial fact you need to remember. The market actually goes sideways about 80% of the time. If you try to force a strong trend strategy in a sideways market, you are going to get chopped up.
Okay, let's move into our tactical plays with Strategy 1, moving averages.
This first setup uses the 10-period and 20-period simple moving averages, and it really comes down to a super strict 3-step rule. Step 1, you wait for a clear trend above or below both of those lines. Step 2, and honestly this is where most people get too impatient, you have to wait for the price to pull back to the moving average. Then, Step 3, you wait for your confirmation to actually enter the trade.
So what does that confirmation actually look like in practice? It's going to be a rejection candlestick right at that moving average line, something like a bearish pin bar or a bullish doji. That is your definitive signal that the pullback is officially over and the main trend is resuming. Just crossing a line isn't enough, guys. The candlesticks have to literally prove to you that the level is holding.
There's also this really cool concept called price deviation, and you can trade this using just a single 20-period exponential moving average. Basically, think of the price like a giant rubber band. When a really aggressive move stretches the price way out from that 20 EMA, it naturally wants to snap right back to its average. Trading that rubber band snapback is an incredibly effective setup.
Moving right along to Strategy 2, momentum wicks.
This second strategy is fantastic because it brilliantly blends pure price action with supply and demand zones. First, you've got to map out your zones. A supply zone comes from a rally-based drop. Price goes up, consolidates a bit, and then just aggressively drops. That leaves behind a massive amount of institutional selling pressure. A demand zone is the exact opposite, a drop-based rally. When price eventually wanders back into these zones, a trap is essentially set and waiting.
Once the price hits those zones, you are on the hunt for momentum candlesticks. For instance, if the price pushes up into a supply zone and you see a massive upper wick form, that is proof. It proves buyers tried to push it higher and sellers just fiercely rejected them, knocking the price right back down.
And the magic number you're looking for here is 3. To get the absolute highest probability trade, you want to see at least 3 multiple wick rejections inside that zone. If a zone gets rejected 3 distinct times with these long wicks, it's a powerful statistical clue that a reversal is imminent.
All right, on to Strategy 3, the pattern scalp.
I love this one because it leverages a phenomenal truth. 90% of a day trader's money is usually made in the very first hour of the session. Here's your sequence. First, sit on your hands and do absolutely nothing for the first 15 minutes. The second that opening 15-minute candle closes, draw a box around its high and its low. Step 2, confirm if it's a manipulation candle. And Step 3, drop down to your 5-minute chart for the reversal entry.
So how do you actually spot that manipulation? How do you know it's a trap for retail traders? You look at the daily average true range, or ATR.
If that single 15-minute opening candle violently chews through more than 20% of the entire daily ATR, that is excessive. That is an emotional, manipulative event, and the odds of it reversing are incredibly high.
The moment you spot that manipulation, you drop to the 5-minute chart and hunt for your triggers. You're looking for things like a John Wick hammer candle or a Power Tower engulfing candle pushing back the other way. But here is the golden rule for this framework. Never, ever enter on the signal candle itself. You have to wait until the very next candle actually breaks the high or low of your signal candle to confirm that reversal.
Let's wrap this up with part 5, the money zone. This is where risk management comes into play.
This right here is where you actually find your real edge. And honestly, the data is totally counterintuitive. If you get greedy and aim to capture a full 100% target retracement of a move, your win probability absolutely tanks to just 10%. But by aiming to capture a very achievable 25% chunk of that move, your win probability skyrockets to 90%.
90%. Listen, when you're scalping, your win rate is your entire engine. This isn't swing trading where you're trying to catch massive runners. Scalping is all about precision. Hitting that 90% win probability by targeting those smaller zones, that is the literal difference between erratic gambling and consistent professional results.
So the absolute rule of thumb for this approach is to lock in those profits early. Always aim for a realistic 2-to-1 risk-to-reward ratio. That securely grabs your 25% slice of the pie. And over time, those consistent, small wins are going to snowball into some really massive account growth.
So to summarize the playbook today, these strategies work purely because they rely entirely on the undeniable laws of market structure and precise candlestick confirmation. To really get this down, you need to master one single model first, test it endlessly on historical data, and above all else, stay strictly disciplined to your rules.
I'm going to leave you with a final, provocative question. Which of these 3 high-probability scalping models are you going to commit to mastering first? Are you going to go with the moving averages, the momentum wicks, or the pattern scalp? Pick just one, pull up your charts right now, and go test the data for yourself. Thank you so much for hanging out with me for this explainer, and I absolutely can't wait to see you apply these strategies.